Hello, everybody. Today we're reviewing the last of my liquid investment strategies, Diversified Income and WealthPlan Armor. I'm David Warshaw, Certified Financial Planner at the WealthPlan LLC, and today we're playing portfolio defense and showing you strategies to protect your hard-earned investments. And be sure to stick around to the end because I'm going to be showing you new product solutions you've probably never ever seen before, even on the YouTubes or whatever social media you frequent. For real. And if you haven't watched my core strategies video yet, go check it out. That's where I explain the framework I use to build all my client portfolios. Think of these satellite strategies as the sidekicks, but the core models, those are the real stars of the show. Okay, up first is what I call my diversified income strategy. The objective here is simple. Income first, growth second. This portfolio is structured to deliver regular cash flow through dividends, option writing, and fixed income interest, while also providing equity exposure for long-term capital growth. And like most of my strategies, this one is buy and hold at its core. Steady, disciplined, long-term. Now, in the model portfolio today, I'm using more passive investment strategies to keep costs down, but active managers are totally allowed in the portfolio if I like them. Now, let's take a look under the hood. This portfolio holds 9 exchange-traded funds, ETFs, which gives you exposure to roughly 1,688 securities. It's a lot of securities. The lineup includes U.S. and international dividend players, momentum-driven stocks, option writing strategies, preferred stocks, treasuries, and high-yield bonds. In short, it's a multi-asset portfolio designed to spread risk around while capturing multiple income streams. For benchmarking, I use the Vanguard Balanced Index Fund Admiral shares, ticker VBIAX. That's a respected 60-40 balanced fund, 60% in stocks and 40% in bonds. We also keep it disciplined with once-a-year rebalancing. No chasing headlines here. So who is this portfolio suitable for? Well, income-driven investors with a moderate risk appetite. I built it for my retired clients and my clients who just love dividend income investing. And the reason I like it is because if the market goes flat for a number of years, at least they're earning that steady stream of income. With about 30% in bonds or fixed income investments today, you get some stability while still leaving room for equity-driven growth. It's definitely not risk-free, but a balanced approach for investors who want income today with growth tomorrow. Now let's turn our attention to my next model, the one I call WealthPlan Armor. What if you could protect your money from, big losses while still staying invested in the market? That's exactly what this strategy is built to do. For some people, especially the more wealthy the people are, they care a lot more about protecting their existing asset base than growing it. Preservation is the name of the game. So with that said, we're going full-on protection mode here, people. Imagine raising your giant Legend of Zelda shield. That's from my gamers out there. This strategy can include insurance solutions, unit investment trust, and structured notes. But today, I want to zero in on my primary go-to solution for this strategy, something called defined outcome ETFs. Say what? Defined outcome ETFs, also known as outcome-oriented ETFs or buffer ETFs. I know it's a mouthful. Sorry. All right, so what the heck are these defined outcome ETFs? Well, traditional ETFs, as you know, just track an index. But defined outcome ETFs are different. They're built different. They use options to shape returns around a specific goal. Think of them as ETFs with a built-in strategy. Some try to boost returns. Others focus on income. But the ones I love most are built to limit losses if the market drops precipitously. I just wanted to use precipitously in a YouTube video. So let me explain what I mean by this term, buffer. A buffer ETF gives you downside protection up to a certain point. For example, let's say you buy one of these buffered exchange-traded funds with a 15% buffer. If the market drops 10%, you don't lose anything. The buffer absorbs it. Think of it like a sponge. But if the market falls 20%, you'll only lose the amount beyond the buffer, so 5%. Now, some products go even further with what's called a 100% buffer. This is one of my favorites. In those, the ETF is structured so that even in a worst-case scenario, Your losses might only be limited to 1, 2, maybe 3%, depending on the product used. That's about as close as you can get to all-weather protection while staying invested. And boy, have people taken notice. These ETFs have exploded in popularity. Since launching in 2018, the space has grown to about $60 to $70 billion in assets by mid-2025. One of the biggest players in the space, a company called Innovator ETFs, just crossed $27 billion in early 2025. Other major providers include First Trust, Allianz, iShares by BlackRock, and Goldman Sachs. Now, new funds launch monthly or quarterly, giving investors fresh entry points. And there are so many benefits to these products, some of which include 1. Liquidity. You can buy and sell anytime during market hours. 2. Transparency. There's daily disclosure of holdings and values. 3. You can choose your reference asset. Think S&P 500, NASDAQ 100, Russell 2000, and so many more. 4. Easy access. You could trade them in your brokerage accounts, IRAs, Roth IRAs. No special hoops to jump through, no special paperwork. 5. There's flexibility. You can choose your buffer level. There's 10%, 15%, 20%, 30%, or as we mentioned earlier, 100% for full protection, depending on your specific goals. Now, looking at Innovator's assets under management today, the most popular buffers are 15% and 100%. 6. Safety. There's no issuer credit risk. These are funds, not bank IOUs. This is a big deal after the collapse of Lehman Brothers back in 2008. 7. There's an automatic reset feature. Options reset each year, giving you a fresh buffer and an upside cap. This reset feature makes these products easier to manage, almost set and forget type products. And lastly, number 8, investor psychology. These products reduce the fear of big losses, helping investors stay fully invested. And staying invested is one of the cornerstones of long-term investment success in markets. But like everything else in the wonderful world of investing, there are risks and trade-offs you should be aware of. First, your upside is capped, thereby limiting your gains. That's kind of the gotcha here. If the market surges, you won't capture it all. It's a total opportunity cost. 2, higher fees. These products' average expense ratios are around 0.5% to 1%, much higher than plain vanilla index ETFs. 3, timing risk. They're designed for different time periods. Buy or sell mid-cycle and your results may differ from what was originally advertised. 4, market risk. Buffers only go so far. A 15% buffer won't save you in the event of a 40% crash. You'll still absorb losses beyond the cushion. That's why I like the 100% buffers. 5, complexity. These are just more complex products. Investors need to understand how they work. And lastly, 6, their product differences. Not all of these products are created equally. Providers vary in structure, buffer amounts, costs, and other product features. You should know what you're buying. Bottom line is, defined outcome ETFs are like a safety net with guardrails. They're very customizable products with some awesome features, depending on your specific needs. And in today's volatile world, that can make all the difference. Although it does seem like people have forgotten just how volatile stock investing can be. All right. Now it's time, as we always do, to dig into the portfolio metrics using my Koifin Analytics platform and the Innovator website. Let's take a look at the diversified income model in Koifin. What you basically see here is some of the holdings. We have a nice mix of different size companies, as you can see in the style box. Expense ratio is 0.31%. When we look at the underlying sectors, you see a nice diversified portfolio. A lot of the different sectors are covered. You see some global diversification with around 68% of the portfolio being domestic in the US. Different bond asset classes in this model alongside different credit qualities and, of course, maturities. Now for the best part, we're going to analyze the returns of the diversified income model. The first thing we want to focus on is, well, the income or the yield. And if you look at the yield, it's currently 5.51%. And the benchmark's yield is only 2.03%. So we're yielding more than double the yield of the benchmark. And that's great. That's what the purpose of this portfolio is, to generate meaningful income every single year for you, as I mentioned earlier. But the yield isn't the whole story. What you really want to focus in on is the total return, and that includes the dividends, the interest, and the capital appreciation of the underlying securities. When we look at the returns, we could see that in 2024, it was up 8.19%, and in 2025, the diversified income model was up 12.03%. Once again, this strips out any advisor fees. It only looks back in time. It doesn't reflect changes that were made. Now, that's not a very long time, and at least year to date, it is outperforming the benchmark. So, to be fair to the benchmark and to the portfolio, what I did was I created another model that I swapped in some comparable securities that had a longer track record, because some of the securities in my model just don't have that long of a track record, and that affects the historical performance. So looking at the historical performance, you could see that year to date, this portfolio is beating the benchmark. Over the last 3 years, the model was only up 9.89% against the benchmark's 11.44%. In the last 5 years, this model is outperforming the benchmark 9.15% versus 8.55%. Now, once again, this does strip out any changes that I would make going forward. So you have to take the historical performance with a grain of salt, even though it did better. And of course, past performance is not indicative of future results. Now, looking at my WealthPlan Armor model, I'm going to show you how to navigate and explore this website because it's chock full of really good stuff. So innovatoretfs.com is the website. So we're going to go to the product table. That's where I would suggest you start. And you're going to choose your reference asset. In this case, I want the S&P 500. I want a buffer product. And let's say I want that 100% protection. I'm going to rebalance once a year. So I'm willing to hold this for the next year. And I'm going to look at the August issue because that's the most recent issue that came out. Obviously, in September, we'll have a brand new fund that we could look at. ZAUG. Equity Defined Protection ETF. Now, if you would have purchased this ETF on July 31st, 2025, your cap would have been 6.49%. Once again, in English, that just means that if the S&P 500 was up 10%, you would have been capped at 6.49%. If the S&P 500 index was up 15%, you would be capped at 6.49%. If the index was only up 3%, you'd only be up 3%. And the downside risk is, hey, you could lose 0.79%. That is after expenses of the fund. So I could make 6.49%, and the most I could lose is 0.79% based on how the index moves. Then this is constantly updated. Well, what if you were to buy it today? What would that look like? So you can see the cap went down from 6.49 to 5.71%, and the downside buffer went from 0.79% on the downside to negative 1.52%. So I would just wait for the next issue because this is not as attractive. But we, of course, have to take a look and see the numbers on the new issue. Okay, going back, what if we said, okay, I want the S&P, I want buffer, but I'm willing to tolerate some loss. Let's do the 15% buffer. Now I only have a sponge of around 15%. I'm going to absorb the first 15% of the market's losses. 12 months, August. So if you would have purchased this fund on July 31st, you see your cap is 11.46%, a heck of a lot higher than the cap we just saw of 6.49%. I could get a lot more on the upside. Market's up 15, I'm only going to get 11.46%. Market's up 5%, I'm only going to get 5%. So much better cap, and your downside would have been 14.21%. So if the market went down 25%, you would be on the hook for 10.79%. If the market went down 40%, you'd be on the hook for 25.79%. So the investors who go with a product like this with that 15% buffer, they're willing to tolerate some losses in order to get a higher cap, knowing that if the market did drop 20, 30%, they're really only protected for the first 14.21% and would absorb anything after that. So there you have it, my friends, two of my more conservative investment strategies for my actual clients. Diversified Income and WealthPlan Armor. They may not be flashy, but they're built for stability, income, and protection. I truly hope this video was educational. I'll see you in the next video soon. Take care. Bye-bye.